Hey everybody, Marty Mazzara. Good afternoon, 10th of August 2017. For regular readers and viewers, this should look very familiar. The three moving averages are your 50, your 100, and your 200 day. That's the order they line up in. The shorter or the faster moving averages being on top of the slower and longer term moving averages are bullish in terms of what they say about the trend. As we've talked about here on numerous occasions, these also tend to be technical support for the market. So again, here's a one-year chart of the S&P 500. Back leading up to the election, you can see we broke down through the moving averages. There's a 50 drop below the 100. Turned out that the 200-day was support. That's when the election happened right in here. Got the nice bounce. Been pretty good ever since. Tested the 50 a few times, testing it as we speak. Here it is today. If you read yesterday's blog, I pointed out that 9 out of the last 10 days and the year so far as a whole, we've been seeing some late day action that would suggest the market's in a very bullish mode. Doesn't look like today that's going to play out. The Dow's down almost 200 as I speak. It actually looked like it here just a little bit ago. We were down like 170. We were only down 90, and that's precisely when the president said that perhaps his comments that fire and fury would be levied in a way the world has never seen. Maybe those weren't strong enough. Immediately, the market reversed course. If I were a short-term trader, I would definitely not want to go in overnight waiting for the reaction from North Korea. But anyway, beyond that noise, which is what it is at this point, we have to keep our eye on the longer term trends and so on. So again, that's what we're doing here today. And as I just pointed out, the moving averages would suggest we're very much in a long-term uptrend, and we're seeing what right now would be volatility to ignore. Wanted to show you retracements. The technicians, they call these Fibonacci retracements. They're very important. I do know for a fact that they are closely watched and respected and even traded. We pay attention to them just to get a feel for what the short-term thinkers may be doing and thinking. So here we go back to the election low, to the recent peak. Typically, you want to focus on 38, 50, and 62% retracements. And as you can see right now, we are nowhere near normal retracements within the context of an ongoing bull market. Ironically, right now, the first level, what is typically strong support, also intersects with the 200-day moving average. So if we got there in a hurry, that would be something that I would suspect would be a tough thing for the market to penetrate to the downside. Of course, anything can happen. One other area I'm noticing here on the chart is right in here. Not only would you have the 38% retracement corresponding with the 200-day, but you'd also see it falling right on what was really strong support back here in March of this year and then again in April. Okay, so moving on, let's take a look at non-US. Our core exchange-traded fund, which is in just about every portfolio, is the EFA, Europe, Australia, and the Far East, is the index that it tracks. Here we are at the election low. Here we are at the recent high. Here we are a long ways from any normal retracement. The 200-day happens to correspond with the 50. Nice range here of sideways action. That would be a consolidation phase. Normally you bump up against the bottom line here before you break out in one direction or the other. So the potential for more downside action in non-US to come as well as US. Moving on, here's the exchange traded fund that tracks the Euro Stoxx 50 index. So you can see it's testing its 50-day moving average as well, flattening out there. We could point our range in here if we like and suggest that there's a consolidation going on there. We would expect a test of this before we break out in one direction or the other. Using the typical retracements, we move back here to the right about there would be your election low, bring it up to this high. Not even close of yet. Looks like the 50-day is an area that we've had some support before. Interesting, there's a gap here that we had a big jump. I think that was during the French election or the results of the French election, finding support right in here since. So again, technically speaking, just volatility within the context of an ongoing bull market. Here's a trend line that we drew the other day showing that right now, we're testing what would be the longer term trend line. If we break through that, we'd be looking for support 100-day moving average. Now taking a look at our core emerging markets index exchange traded fund. As you can see, the moving averages are all lined up in the right place for a bullish trend. Still yet to test the 50-day moving average. You bring up the retracement levels, and as you can see, We are still a long ways to go, and ironically, the 200-day corresponds with the 50. This is where we would look for very strong support. Looking at financials, XLF, or financial sector ETF, as you may know, we had a huge run after the election, been consolidating ever since, and are looking to break out of that consolidation range, although with recent action, we're stepping right back into it. If I were to draw that trend line, this is what we'd see right here. We've been testing it again now as potential support, but looks to be closing lower than that area on the day. Looking at our Fibonacci retracement levels, going back to the election low right here. Before we move on to the recent high, I wanted to show you how these retracements can work. Here we have that nice run coming out of the election, and here we have financials notably peaking right here, and then we see a retracement. Notice how strong and how important that first level of support at 38.2 happened to be. You can see it touched it, bounced off of it, bounced off of it, bounced off of it, and essentially tested it 4 times before it beat it, and then found support at the 100-day moving average. And here we are playing with that high. Taking a look at technology stocks, the best performing sector in the U.S. so far this year. You can see we've had a very nice run since the election. Right now, looking to test that 50-day moving average. Back here in June, we actually came down and then found support at the 100-day, moved our way off of that. Bring up the retracement levels, and we go back to the election low, move it up to the recent high, and as you can see, we've got a ways to go before we test anything. Nice consolidation box probably right in here. Interesting to see if we come down and test this level as well. Taking a look at industrial stocks, again, similar look with the moving averages, although coming down, definitely coming below that 50-day moving average here today. I can draw my consolidation areas. Clearly, that's what would be considered as going on in here. We have some room to move down. Ironically, that corresponds right with that 100-day moving average. So, folks, what I keep pointing out, and I'll do it here again with the Fibonacci retracements, is that technicians are, of course, these are people who trade these charts and these levels, giving you an idea of what areas they would be looking at to take advantage of this downdraft if indeed we are still operating within the context of an ongoing bull market, which is what the technical indicators at least are suggesting for now. And then we'll finish up here with materials. As you can see, material stocks have breached the 50-day moving average today, testing the 100-day. See how that looks from a retracement standpoint. Come back here to actually where materials bottom was in October, so we'll use that because that's a clearly defined at least intraday bottom. Come up to the recent peak, and nope, we haven't had enough of a retracement yet to touch these key levels, and if we do, the first one is going to fall right along that 200-day moving average, so you'd have potentially double support there, plus you have a real trend line here that was pretty strong all the way back to the beginning of the year. So folks, again, nothing really going on here that's really all that unusual. In fact, what's been unusual is the lack of volatility that we've seen so far this year. So I will leave it there for now. Thank you as always for watching and listening. Look for my weekend message here in the next couple of days, and I'll talk to you again soon. Take care. Bye-bye.